webinar is being recorded and will be available in the next couple of days, either via the RM2 website, rm2.co.uk, or via our YouTube channel, which is under RM2 partnership. So without further ado, we'll start moving into the body of the presentation. You have to excuse me, there seems to be a slight delay. I'm pressing the button and things happening my end. Hope you bear with me. So employee ownership trusts are trusts which have been specifically set up for owners to sell their businesses to. They are a specialist form of employee benefit trust, or EBT. But in the last number of years, the last sort of 5-10 years or so, EBTs have got a bit of a bad reputation in that they were used in some tax avoidance schemes where companies were finding ways in which to pay employees without paying any tax at all. That is the reason why you've got Ranger's picture at the bottom, who is one of the major culprits in this. Just to put your mind at rest, this is not this kind of scheme at all. The great thing about EOTs is that the rules around them are governed by legislation, in particular the Finance Act 2014. And therefore it is a very stable structure, and the tax incentives which are around it are likely to be here to stay for some time into the future. The picture of John Lewis is there because the people who drafted the legislation specifically were using John Lewis as the model and wished to encourage owners to sell their businesses in order to form what they were calling a John Lewis economy. So since 2014, after it has to be said a fairly low start, because they weren't particularly, in fact they're still not particularly marketed, there's been about 300 transactions, but there are becoming more every year. And the picture of Wallace and Gromit, Richard Sounds, is just to show you some of the major or best known companies which have now done these transactions. So Wallace and Gromit makers Oddman Animations sold their business to an EOT, I think at the back end of 2018. Richard Sounds, which actually was the first time the media really took attention or paid attention to an EOT transaction, was sold in 2019. And then you got Riverford Organics, which was one of the first companies to start selling organic vegetable and other foods via mail order. And then the group of people standing at the bottom is actually an architects company called AHMM. But actually, you could that could catch all of architects who have really embraced the EOT idea. And I think on the last count, it was something like 15 out of the top 100 architects in the country are now EOT controlled. So I thought it'd be worth just sort of looking at the reasons that our clients tell us that the EOT transaction appeals to them, and we kind of characterize this by giving the objectives that the owners have when they're actually trying to sell their business and potentially exit their business. So the owners may not be particularly looking to maximize their value, because frankly finding a competitive market with more than one buyer is a way to increase the price of your business to its maximal level. However, they can achieve a fair value, which we'll go into more detail at the end during the presentation. But more so, it keeps the business intact. I mean, I always say that the business after an EOT transaction is pretty much the same business as it was before the transaction. So you've pretty much got the same management team, same management structure, same culture within the business. It is a very gentle transaction. As a result, the business will hopefully go on for many years to come and leaves a legacy that the previous owner can look back on, while the previous owner can also exit gradually at their own speed, because there's no obligation for the owner manager to move away from the business. It gives them plenty of time to do their succession planning. If you did a transaction with a third party, that's often characterized by a price being agreed, but then a percentage, and sometimes a fairly large percentage, having earn-outs attached to them with conditions. So an EOT transaction, you agree a price up front, and that is the price that the trust will pay, assuming that the business continues on a profitable, being profitable into the future. Minimize risk and conflict. So third-party transaction, conflict comes from negotiations, which can go on for a very long time, can be very, very distracting. And there's always the risk, there's an exercise risk that at some point your buyer can just walk away from the transaction. Because an EOT transaction is a friendly transaction, there is very, very little risk of it falling down. Really, the only risk is that the owners kind of change their mind. Owners often want to look after the employees, and actually keeping a stable business which isn't changed into the future is one way to do that. And it also gives a mechanism to reward the successors. So the people who are taking the next generation of directors, because an EOT transaction, although you are selling a controlling interest of the business, there is lots of scope to have minority interests, which may be the key employees of the business into the future. So just the clear alternatives and better known ways of selling businesses are your trade sale, your private equity, to a smaller extent IPO. And on those kind of transactions, because you're having you're not just usually changing the ownership, you're changing the management of the business. And as a result, it might have implications to the culture of the business or the way the business works. And therefore, inevitably, there is going to be a change, and sometimes quite significant change to the business. And therefore, it doesn't really sit entirely with the objectives that owners tell us that EOT works with. Liquidation is down there because actually some people who wish to retire or exit their business just can't find that owner, and the only other option therefore is kind of liquidation, which is often a shame for businesses which got plenty of future left in them. Management buyout is probably the traditional method which is closest to an EOT. But the big difference with that is in most management buyouts, the purchasing managers will usually go into some sort of debt in order to purchase the business. The EOT transaction does not require the next generation of directors or management or any employees to take any financial risk in the transaction. So going into a little bit more detail of what an EOT transaction is. So the shareholders sell a controlling interest in their business to a trust. The word controlling is very important, so you have to sell 50% plus. We'll go into a little bit more detail. The trust is for the benefit of all employees. So all employees will be included. Again, we'll go into a little bit more detail. Now, because the legislation wished to encourage a wider share ownership or a wider ownership of businesses, there's some fairly eye-catching tax incentives, both for the sellers in that you can sell for CGT free, and for the remaining employees who can then hook into tax-free bonuses, assuming there's a fund to pay the tax-free bonus on an ongoing basis. Now, because an EOT is governed by legislation, there is, of course, a number of criteria or requirements that must be met in order to be a compliant EOT transaction and therefore be able to take advantage of both the CGT relief and the tax-free bonuses. And we will now go into a lot more detail about those particular requirements. So the EOT is set up, and the beneficiaries of the trust is all employees, and they must be on the same terms. So just to note that the employees are not becoming shareholders of the business. The predominant shareholder of the business is the trust. The employees are the beneficiaries of the trust. Now, where we say all employees, there are a couple of exceptions to that. So if you've got new joiners, you can have a qualifying period before they become beneficiaries. But even then, the maximum qualifying period you can have is 1 year. Hello, I think I'm back up. Hopefully I haven't lost too many of you. I'm really apologize for this. I lost internet connection for a second, so did the classic turning things back on again, turning off and on again. So really apologize for that. I think I've got about, I think most of you are kind of staying with me, so I really appreciate that. So I was talking about participators. Hopefully I covered that. So moving on, the term on the same terms, effectively the beneficiaries, if there were funds to be allocated out of the trust, which would essentially usually only happen if the trust sold its shares, the contribution for those shares would have to be distributed to the beneficiaries on an objective basis, and this is the same terms. So you would either have to split it equally, or you would base it on remuneration, on hours worked, or length of service. This is more important really in terms of the allocation of the tax-free bonus, because those are allocated on the same basis. So moving on. So the top one is pretty much self-explanatory. So the company must be a trading, must trade or be a holding company of a trading group, i.e. it can't be an investment company. Control must pass to the EOT. EOT must have 50% plus one at least of the share capital, but that's broken right the way down. It's got to have more than 50% of the actual numbers of shares, has to have more than 50% of the voting rights, has more than 50% of the rights to profits, and more than 50% of the assets on winding up. Predominantly companies that do sell to, or owners that sell to EOTs, actually do sell 100% of the business, and that's partly because of the last point, is that the CGT relief is only available in the tax year when control passes. So if you retained, and a lot of people do retain a share of the business, so you sell 80% and retain 20%, when you come to sell your 20%, you will no longer be entitled to the 100% CGT relief. You may be entitled to entrepreneur's relief because you still own more than 5%. It's also worth mentioning that although the trust will have the rights to 50% of the profits, trusts generally will waive their rights to dividends, effectively because it's a very tax inefficient way of distributing money to the beneficiaries, because the trust would pay tax as the money comes into the trust, and then the employees would pay tax as it's distributed down to the employees. It's much better than to pay a bonus directly to the employees in order to distribute those funds. You only have to pay tax once. This is a more subtle requirement, and although we put a sort of a formula on there, it can be best described as it's a limit on the number of employees who are also participators or had that more than 5% equity in the business. So out of the total number of employees, you have to have less than 40% as participators or family members of participators, and the definition of a family member is pretty broad because it's including uncles, aunts, nieces, nephews, and those married to uncles, aunts, nieces, and nephews. However, this requirement is time constrained, so you have to be compliant within the 12 months before the transaction, and then up to the end of the tax year in which the transaction takes place. It's probably worth mentioning, just comparing the relief that you can get, the tax relief you can get from doing an EOT transaction to the sort of classic entrepreneur's relief, which obviously has become a lot less beneficial than it was a year ago. So in terms of minimum holding, in order to require to be entitled to entrepreneurs relief, you have to own more than 5% of the equity for a 2-year period. There is no such requirement or constraints on an EOT relief. For entrepreneurs relief, you have to be an employee or an officer, whereas you don't have to be employed with the company to benefit from the EOT relief. You have the relief you can get from entrepreneurs relief is taking the CGT from 20% to 10%, but it's only for a lifetime limit of now £1 million, whereas for EOT there is no limit and there's no CGT. In fact, you could sell your business via the EOT and that would not affect your lifetime limit on entrepreneurs relief, so you could go up and start another business up and use entrepreneurs relief if that suited you more. Big difference in terms of entrepreneurs relief and EOT relief with conditions post-sale is that there isn't any for entrepreneurs relief. However, the business, if the business very quickly after the transaction with an EOT becomes non-compliant, for example, the EOT loses its controlling shares, then the tax that has been avoided by the owners then becomes payable if that happens within the tax year in which the transaction took place or the following tax year. So a big question about how an EOT is actually funded. So essentially it is funded by the profits, the future profits from the business that is being purchased and the cash which is on the balance sheet. So essentially what happens is the shareholders sell their shares to the trust. Trust has no funds, so excess cash which is on the balance sheet of the company being bought will then be used to pay an initial payment to the shareholders, and after that a loan, a great big IOU, will be created in the trust and that will be paid over time. Now that could be a vendor loan, or about 20% of the transactions that we do, there is third-party funding where a bank actually finances the transaction. So it's actually the bank that lends the money to the trust to buy the shares, and then that increases the initial payment to the shareholders. I hasten to add that decreases the risk in terms of the shareholders, but obviously increases the risk for the company, which is obliged then to pay that third-party loan, and banks are less understanding in terms of delays of payment than a vendor might be. Private equity is down there. There is some private equities who have been involved in funding EOT transactions. It is pretty rare, because the problem for a private equity was, whereas they like to take a controlling share of the business, obviously with an EOT transaction they would have to take a minority interest. It's sort of noted that as you go down the particular page, the cost of these ways of funding effectively increases. So now we're going to just work through a typical EOT straightforward transaction. So the first thing which happens is a trust is created. So the EOT is created, trust deed is written, and the company recognizes the existence of a trust. A price is agreed between the shareholders, the trustee of the trust, and the company. Now, essentially, as I mentioned before, this is not a situation where the valuation of the business is based on what somebody is prepared to pay for it. Because it's a friendly transaction, because there's not any particular negotiation, what tends to happen is you get a valuer to value the business, and that will be the basis on which the price is actually agreed. The trustees officially cannot pay more than a fair value for the business, and that fair value is established usually by the valuation. We have had a number of clients who have then chosen to sell for less than the valuation, but that's entirely their choice. I would say the majority do sell for the full value of the valuation, or very close to the full value of the valuation. So transaction takes place, the shares are then sold to the EOT, and the debt is created in the trust to be paid over a period of time. Essentially, we usually expect the repayment to be around about 5 years or so. So over the course of time, the company is then passing over the excess cash, which it might do immediately, or it's then passing over the profits which are generated by the company to the trust and then subsequently to the shareholders. It's worth noting that the profits which are passed over are coming out of post-tax funds. Unfortunately, this is not an expense that can be offset against taxable profits. It's like a dividend that's being paid, but you don't call it a dividend, because if you called it a dividend, you'd have to pay tax on it. So it's kind of a gift out of distributable reserves. It means you are limited in terms of what can actually be paid over and how quickly you can pay it over, one, by the level of cash in the business, but also by the fact you've got to have the distributable reserves to then to make those payments to the EOT. In reality, most trusts do not have bank accounts, so the company will be paying directly to the shareholders, and it's just an accounting mechanism where the funds go through the trust, the debt is reduced, and then pays it out to the shareholders. Many transactions, the shareholders will have their payments secured with a charge over the assets of the company. They cannot have a charge over the equity of the company, because you are not allowed to set up a mechanism which ultimately might return the shares back to the shareholders. That is not allowed by the legislation, but you can have a charge over the assets. So in the worst case scenario, if the company fails for whatever reason, the vendors will have first shout over the assets of the business before other creditors are paid. It kind of protects the shareholders. To be honest, we've not heard of a single a single EOT transaction where that charge has needed to be used. So the transaction is being done. The shares have been sold. The EOT is controlling the business. So this now opens up the possibility of the company paying tax-free bonuses to employees. And we'll go into a little bit more detail on that in subsequent slides. And then there's this other bit in terms of, so if you get a transaction where the trust has bought 100% of the shares, it does open the fact that because the trust only needs to own 50% plus 1, you can have minority interests, and this all falls back into the sort of requirement basically of, one, rewarding the successors, the next generation of directors, but also incentivizing and motivating those directors to stay in the business in order for the business to sort of go on to the next level, be successful, and generate the profits also to pay off the shareholders' debt, which is sitting there. Again, we'll go into a little bit more detail in the subsequent slides. So tax-free bonus, there is a maximum of 3,600. It's supposed to be reviewed from time to time, but unfortunately it's the same number which was started back in 2014. You would expect over time that will be increased, but at the moment it's still 3,600 can be paid tax-free via a bonus. These tax-free bonuses, as I said, you have to pay them on the same terms, so you have to use the same criteria. So if you've got a bonus pot and you have to, everybody has to get everything, so something has to go to all employees, and you can distribute it either equally across all employees via the remuneration, via length of service, or via hours worked. And when we say it needs to go to all employees, because the bonus is paying by the actual company and not out of the trust, the people who are restricted from being beneficiaries are not restricted from receiving this 3,600 bonus. In fact, in terms of if the previous shareholders are still employed in the business, it's not just that they can receive the tax-free bonus. Because everybody has to receive something, they have to receive the tax-free bonus. And therefore it can go to everyone. So the last point is that there is no national insurance relief, therefore you have to pay employers and employee national insurance. Now going into a little bit more detail in terms of the share incentives for employees. So again, because the trust only needs to own 50%, there is plenty of scope for there to be a minority interest. And you get a really nice, there's a great opportunity in terms of incentivizing key staff in the way that the EBT transaction works. So if you've got say a £10 million business which is sold for £10 million to the trust, however, it's all been sold by vendor debt. So you get a loan in the trust, which the business is then obliged to pay. If the valuer then sort of came back the day after the transaction, they would say, okay, this is a £10 million business yesterday. However, you've now got a £10 million worth of debt that you're obliged to pay, even though it's with the trust. Therefore, this business is not worth a great deal. Sounds very negative, but it's a fantastic opportunity that shares can now be sold to employees, or you can set up an EMI option scheme to employees with a very low exercise price without any benefit in kind issues. So effectively, your key staff can take a share in the company at a very low cost, and then as the debt is paid off, the value of the company goes hopefully back up to the same level and more, and suddenly they got a very valuable asset which they didn't really pay very much for. It's a fantastic opportunity. Obviously you need to do those transactions very soon after the EBT transactions. We find most of our clients in one form or other take that opportunity. Sort of mentioning EMI share options because this is a very tax efficient way of setting up these transactions, because one, you can actually get the valuation of the company that you've decided cleared by HMRC at the time you're doing the transaction, but also when the recipients exercise the share and then come to sell their shares and get a gain, they will be entitled to entrepreneurs relief, assuming they've kept the other conditions. For example, they've had their options or shares for more than two years. And just at the bottom, even if you do an EMI option, you can actually have it immediately exercisable. So some people say, actually don't like the idea of options because people don't particularly understand it. I just want shares. Well, you can still do that through an EMI scheme, but just convert it very, very quickly. So we are kind of winding up now, just due to the mishap. I've kind of speeded up a wee bit, so please forgive me for that. But just sort of a quick benefit, a summary of the benefits. So I mean, basically, I kind of summarized in this in that you can, the key benefits for doing these kind of transactions is, one, you don't have to do a third-party transaction with all the hassle, disruption, passing on, disclosing confidential information to your competitors, and then have the risk of a third party walking away at the end of it. Plus, it leaves the business entirely intact. It's a very gentle transaction, so that the business almost just continues on as if nothing has happened. And at some point in the future, then the employees can really take financial benefit of the shares that they indirectly own. Just at the bottom of that slide, it's really worth mentioning as well, you can get HMRC advanced clearance on the structure of the transaction. So you can be pretty comfortable that whatever transaction you set up, it is going to be compliant as far as HMRC is concerned. And that's so that it won't come under any scrutiny or attack into the future. So to end it all off, you get a transaction where employees become the beneficiaries of the business, and it's very, very sustainable. And increasingly, employee trust ownership is a proven business model. And there's becoming increasing evidence that it can increase employee engagement, which leads to higher productivity. And you know, these kind of transactions, although slightly different in the US, have been around for a lot longer, and studies have been done in order to, that are showing that productivity goes up. And probably very particular for our current circumstances, employee-owned businesses do tend to be more robust to a downturn. So I apologize for the technical issues that we had. Unfortunately, I'm sitting in an office all by myself, and I've got nobody who really knows the technical things particularly, so apologize for that. Just a reminder, if you do want a book, please drop me a line. If you have any questions, please drop me a line. You'll have to sort of forgive me that there may be a slight delay for me getting to the post office. I'm just going to have a quick look to see if there's any questions. And there aren't. Just thank you, Nicola. There is one question actually. Any disadvantage to an EOT? I would say, well, not many, frankly, because it's a very gentle transaction. It's a transaction which, to a large extent, the sellers control. However, there is one very, very obvious one: is that you have to be a lot more patient for your for the proceeds. Third-party transactions, basically, you'll get more money up front, although you may get these earnouts, which you may or may not get. This one, you are entirely reliant on the company continuing to produce those profits in order to reduce the vendor debt in the trust, and that is probably the biggest disadvantage attached to it. So there's quite an involved question. To be honest, I think I'm running out of time. There are a couple of questions. What I'm going to do, I don't seem to be able to get I seem to be having problems actually reading those questions. If you don't mind, what I'm going to do is pick those questions up after, once I've closed down the presentation, and answer those individually. So again, apologies for that, the technology is not quite working for me, but I will get back to you as soon as I can. So thank you very much for listening. I hope you found it useful, and stay safe. I hope you stay well, and please drop me a line if you want to continue the conversation. Thank you.